Okay, let's just start with a number. $360 billion. That's how much market value a single company lost in just one day. And that loss, well, it set off a massive chain reaction that absolutely rattled markets all over the world. So the big question is, how on earth did one company's spending plan help trigger a global market crash? We're going to unpack the perfect storm of events that really, truly shook investors back in late January of 2026. We're calling this the domino effect for a reason. In this breakdown, we're going to look at how a tech giant's eye-watering AI bill, mixed with a whole lot of political uncertainty and a dose of geopolitical jitters, created this cascade of consequences that, honestly, almost nobody saw coming. All right, so here's our roadmap. We'll start with Microsoft's shocking AI bill, touch on the anxiety coming out of Washington, see how the contagion began, dive into Bitcoin's wipeout, look at the flight to gold, and then figure out what happens next. Okay, first up, Microsoft's shocking AI bill. This was truly the first domino to fall. It all started with what should have been a great earnings report, but it had one little detail, one terrifying detail that the market just could not get past. And here is the paradox right here. The good news? Record revenue, $81.3 billion, up 17% year over year. Awesome, right? Well, here's the bad news. The spending was sky high. Capital expenditures jumped, get this, 66% to a record $37.5 billion, mostly for AI infrastructure. And that is what spooked Wall Street. And this quote from Matthew Molly at Miller Tabak really just hits the nail on the head. He said Microsoft is not going to garner a strong ROI from their massive AI investment. Their shares need to be revalued. Analysts and investors, they all started asking that same simple question. Is all this spending on AI actually going to pay off? And that doubt, that was enough to trigger a massive 10 to 12% drop in Microsoft stock on January 29th. So the market's already on edge, right? It's teetering. And then a couple of major events unfolding in Washington, D.C. basically poured gasoline all over that fire. First thing was the Fed's ticking clock. I mean, the Powell era was coming to an end. An announcement for his replacement was imminent. And this created a huge anxiety. Nobody knew what was going to happen with interest rates and, by extension, the entire U.S. economy. And check this out. The top candidates, they had completely different playbooks. You had Rick Rieder, who Wall Street saw as favoring lower rates. But then the frontrunner became Kevin Warsh, a former Fed governor known for being a hawk. That means he's a critic who generally favors higher interest rates. So the market saw him as the favorite and immediately thought, uh-oh, rates could be going up and fast. And as if that wasn't enough, the whole world just felt on edge. You had renewed tariff threats against European allies, you had escalating geopolitical tensions, and to top it all off, there were worries about a potential U.S. government shutdown. Look, investors hate uncertainty more than anything, and the world was serving it up on a platter. Okay, so you've got the tech worries, you've got the political anxiety, and this is the moment where it all ignites. The contagion begins, and we start to see stocks and crypto tumble together. And boom, Wall Street was just a sea of red. The S&P 500 down over 2%, the Dow down nearly 1.8%, and the tech-heavy NASDAQ 100 got hit the worst, down over 2%, dragged right into the abyss by Microsoft's historic plunge. Just a brutal day. And guess what followed suit? Crypto. The contagion spread almost instantly. Bitcoin, down 5%. Ethereum, down 5%. That whole idea of Bitcoin being a safe haven, totally separate from the stock market, it just evaporated. When the panic hit, they fell in perfect lockstep with tech stocks. But for crypto, it was more than just a price drop. The contagion hit that market in a uniquely brutal way. It triggered a massive, and I mean massive, deleveraging event. This is the price of panic. Just look at this number. $857 million. That's how much was forcibly liquidated from traders' positions in just 24 hours. We're not talking about people choosing to sell. This was money that was just wiped out. And behind that big number is this one. 167,513. That's how many individual traders got wrecked. That's the human cost. Again, they weren't just selling at a loss. Their positions were completely wiped out. So what exactly is a liquidation? Well, it's when a trader who's using leverage, borrowed money, has their position automatically closed by the exchange. The market moves against their bet, they can't cover it, and poof, the exchange forces a sale. And here's the crucial part.
This creates a death spiral. A falling price triggers these forced sales, which pushes the price down even further, which triggers even more forced sales. It's an avalanche that makes a crash happen way, way faster.
Okay, so amidst all this carnage, the sea of red, there was one asset, a very old, very traditional asset that didn't just survive the storm, it soared. It was the lone safe haven. And you can see the two completely different stories playing out right here. On one side, risk assets, stocks having their worst day in months, the crypto market losing billions. And look at this, US Bitcoin ETFs saw $483 million in outflows in a single day. People were running for the exits. And where did they run? To the safe haven, gold. Gold hit a record high, rallying over 27% for the year, and money was just flooding into gold-backed ETFs.
And the result was this staggering new all-time high, $5,594.82 for 1 ounce of gold. As total fear and uncertainty took over, investors did what they've always done. They ran for the oldest safe haven in the book.
So, after all that, after the dust finally settles on this week of pure chaos, what happens next? What are the big questions we're left with? What did we actually learn from this market earthquake? It really boils down to 3 key lessons. Lesson 1, the AI boom is facing a reality check. Investors now demand to see a return on that investment. Lesson 2, crypto is not a hedge, at least not yet. During a real panic, it still behaves just like a high-risk tech stock. And finally, lesson 3, uncertainty breeds fear. A nasty cocktail of political and geopolitical risks can and will trigger a massive flight to safety, and it can happen incredibly fast.
And all of this leaves us with one massive lingering question. You know, the 2026 crash really tested the 2 biggest stories in markets, the AI hype and crypto's claim of independence. And frankly, they both blinked. So the question for all of us is, was this just a blip, a freak-out moment, or have we just seen the new reality?